Hi everybody, welcome back to part 2 of my Rivian financial deep dive. In part 1 we finished discussing the SG&A line, so we now cover total OPEX, and if we just discuss this line in full, so combining R&D and SG&A expenses, you can see that if we compare the development to 2023, 2024 saw a, let's call it, moderate decrease from 3.7 billion to 3.5 billion. The forecast projects a further drop to just below 3.4 billion, with a subsequent 2026 increase to 3.9 billion. This is driven by predominantly by the launch of the R2 platform, which, as I said before, is expected for 2Q 2026, and with further increase in OPEX in 2027. This is also driven by further expansion of Rivian's vehicle products and substantially increasing sales. As you can see up here, in 2027, the forecast implies almost 160,000 annual vehicle sales, which is a more than tripling of the 2025 guided vehicle volume. So quite crazy growth reflected in this forecast. Keep this please in mind. So with all of that, so what's left for Rivian shareholders operationally? If you add everything up, the operating loss was 4.7 billion in 2024, and the forecast assumes a major drop to 3.3 billion, and a further modest reduction to 3.1 billion in 2026. The reduction is modest in 2026 because when you launch a completely new vehicle platform on new production lines, there are various costs that are being activated, which depress your initial profitability, and this is all reflected here, but I will discuss this in great detail later in this presentation so you understand how it works. And in 2027 you see a substantial year-on-year decrease in losses, but as you can see, losses are still very substantial at almost 1.9 billion. I repeat, everything you'll see in this, what I would consider relatively optimistic forecast, still translate into 1.9 billion, almost 1.9 billion operational losses. I'd like to further point out that this is actually in line with some high-level guidance management drop with regard to 2027, and we'll discuss this also in detail later. But the operating line, operating loss or income, is not EPS. So we also have to look at non-operating line items, which we'll be discussing later, which are not shown on the summary page, to get to also reflecting tax, which is negligible in Rivian's case, to get to net losses. So, and you can see the key observation here is that net losses actually increased from operating loss to net loss in coming years, and we'll discuss why. Historically, so for example, in 2025 it's almost the same, and I'll discuss why, but then there will be some delta that is growing, and that then drives the EPS, or I should say this is one driver of EPS. The other one is the number of shares outstanding, which, as you will see in this forecast, will be growing quite substantially, and the primary driver will be the VW Group investments. So the share count dilution, as it's called, share count dilution means an increase in the number of shares outstanding, has improves the optics of EPS when your EPS is negative. This is the case here in Rivian. When you look at the EPS, excuse me, you can see in 2024 Rivian generated a loss of $4.7 per share. And this forecast projects a significant decrease in losses per share to 2.9, and this is so the reduction in loss per share is supported by the increase in share count, because the losses are spread over more shares. But as I will discuss later in great detail, this is highly negative for any Rivian shareholder, because it makes it so much harder to get to an implied valuation for Rivian that makes any sense. And I'm talking about implied valuation multiples, but I will discuss this later because it's a crucially important point. And you can see, it's another key observation is on an earnings per share basis, For the next 3 years, it's basically guaranteed that Rivian on a full year basis will remain loss-making, and significantly so, I should point out. So at that point, I should refer to some of the key observations. Many of them already touched on. But with this loss-making outlook, we should consider, okay, I mean, there's obviously risk factors. As I said, this outlook is on the optimistic side, but let's review what could be some upsides. One upside could be that VW Group decides to expand the JV. However, there's one issue with that. VW Group, even though they're quite large, etc., their financial resources have also been significantly depleted over the last, call it 10 years. First, Dieselgate significantly reduced cash within VW Group. That was replenished by windfall profits from some COVID effects, but a lot of this cash has now been burned on various failed investments, like the over 6 billion investment in the Caria software unit, which has now all basically gone down the drain, or largely, and some other investments. And the cash flow of the group has diminished significantly, because the key cash flow drivers of VW Group were Porsche and the Audi brand, and both of these key cash flow drivers have seen significant declines, especially the important Audi brand. This means that VW Group is also in a precarious position and is limited in its own financial firepower, and especially in relative to what it can extend incrementally to Rivian, above and beyond the still outstanding approximately 3.5 billion in funding that has yet to be transferred from VW Group to Rivian. And another potential upside is, as I stated here, that there could potentially be another, and I call it VW JV like other partner. So it's conceivable that there's another automaker that shows up at Rivian's doorsteps and says, look, I'm also interested in your EE architecture, can we work together? There's one big problem with that. VW Group formed a JV with Rivian, obviously, and typically in these JV agreements there is some limitation on the partners to extend into additional similar partnerships. This is simply to limit conflicts of interest, because put yourself into VW Group's shoes. You spend actually a lot of money on getting some IP, intellectual property, from Rivian, and if Rivian is working for other OEMs, there's always kind of the suspicion that the company who's developing tech for you could just share the same tech you paid for with another partner, and that's why companies are always highly cautious and try to, in their contracts, exclude such possibilities. And for that reason, and I worked on JVs in my professional career, I think this is a low probability outcome that there's another significant partner similar to VW Group coming into the Rivian nexus. Lastly, takeover considerations. I'm an ex-M&A professional, so I know a bit about this topic. When you talk about takeovers, you always have to think about one, acquisition premia, and you can easily check it by looking up acquisition premia, which is somewhere between 30 and 40% of the what's called undisturbed market value of the company. So say Rivian drops to a 10 billion market cap, so the acquisition ticket would be 13 to 14 billion dollars. Given Rivian's massive net losses, which wouldn't change dramatically under new ownership, at least not over the short term, like 12 months, the dilution to any automaker because of the large implied ticket size for Rivian would be enormous. And no board, I guarantee you that no board would sign off on it. So unless Rivian drops, I'm just pulling this out of thin air, drops at least 50%, nobody will even consider that move. So this video has already become kind of long, and I want to keep these videos short and sweet. So I stop part 2 here, and I hope to see you in part 3. Bye.